When you buy a stock, you might think you're just filling out some boxes on your phone or computer screen. But that one click actually sets off a chain reaction. The question is, what happens next? We'll pull back the curtain to uncover what really happens when you hit the buy button. So when you click buy, here's what happens first. Your device sends a signal through an internet connection to your broker, like a Robinhood, Moomoo, Fidelity, or Charles Schwab. Think of your broker as your direct line to the market. They are the middleman between you and the stock exchange. Next, your broker routes your order to the stock market via the SIP. That's the Securities Industry Automation and Technology, or the SIP. Now, if you're old school, you might have heard of the New York Stock Exchange or the NASDAQ. Those are examples of physical stock exchanges. But these days, most of the action happens electronically through the SIP. Once your broker passes along your order to the SIP, it gets routed to a market maker. A market maker is essentially a big bank who acts as a dealer between buyers and sellers. Their job is to connect buyers like you with sellers so that everyone can get their desired outcome. How do they make money? Through the spread, which we'll dive into in a little bit. The market maker then sends your order to a clearinghouse. The clearinghouse is where all the trades are settled, meaning it's where the exchange confirms all the details like who bought what and at what price. Once everything is confirmed, the clearinghouse sends the trade information to the DTC, the Depository Trust Company. The DTC holds all the records of who owns what shares. So for example, if you bought 100 shares of Apple, the DTC will update your brokerage account reflecting that you now own those shares. Now let's take a look at the order flow from your perspective. From your computer or phone to the market maker to the clearinghouse to the DTC, each step brings us closer to finalizing your trade. This whole process typically takes only a few seconds. But before we move on, here's a quick pop quiz. Which of the following best describes a market order? A. An order to buy or sell a stock at the best available price. B. An order to buy or sell a stock at a specified price or better. C. An order to buy or sell a stock that automatically fills after a set amount of time. If you guessed A, you're right. A market order is an order to buy or sell a stock at the best available price. On the other hand, a limit order is option B. It allows you to specify the price you want to buy or sell a stock at or better. A limit order won't fill if the stock price is at or below your specified price for a buy order or above your specified price for a sell order. In contrast, a market order gets filled as soon as possible at the current market price regardless of whether that price is higher or lower than what you expected. Here's a split screen to illustrate the difference between a market order and a limit order. A market order rushes through the system because it wants to be filled at the best available price right now. Meanwhile, a limit order waits patiently until its price gets triggered. For example, imagine you place a market order to buy 100 shares of XYZ stock at the current market price of $10 per share. After you submit the order, the market price drops to $8 per share within seconds. Since your market order was submitted, the market maker would execute your order immediately at $8 per share even though you may have expected to pay $10 per share. On the flip side, if you had placed a limit order to buy 100 shares of XYZ stock at $8 per share, the order wouldn't fill since the market price was below your specified price of $8. Let's talk about smart routing systems. Brokers don't send client orders directly to the market maker. Instead, they use a smart order routing system. Think of it like a matchmaking service for your trades. These systems optimize where to route your order based on things like the stock you're retrading and the current market conditions. Some brokers even use something called internalization. That's when they take the other side of your trade, effectively becoming both the buyer and seller. Internalization can be good or bad depending on how much profit the broker makes from executing your trade. Some brokers keep it simple and pass your order through to a market maker without taking the other side of the trade. Others might use internalization and algorithms to take advantage of small price discrepancies known as the spread. Speaking of the spread, let's talk about liquidity. Liquidity refers to the number of shares available to buy or sell at a given time. It's all about supply and demand. If there are plenty of buyers and sellers active in the market, we call it a liquid market. This means there's a lot of shares available to trade and your order can usually fill quickly. However, if there aren't many buyers or sellers in the market, it's called a liquid. Your order might take longer to fill or might not fill at all. Here's a simple example. Imagine there are 100 shares of a stock available to trade. If 5 people try to buy those shares, but there's only enough for 3 people to purchase, those 3 lucky buyers will get the shares and the other 2 buyers will have to wait. Liquidity impacts the spread. The spread is the difference between the price a seller is willing to accept, the ask, and the price a buyer is willing to pay, the bid. When there's high liquidity, the bid and ask prices are usually close together, resulting in a tight spread. For example, if the bid price is $10.25 and the ask price is $10.30, we say the spread is 5 cents. Conversely, when there's low liquidity, the spread widens. For example, if the bid price is $10.25 and the ask price is $10.45, the spread widens to 20 cents. A wider spread means more risk. If you submit a market order during low liquidity, your trade could lag or fail to fill, because the market maker may not have enough shares available to complete the transaction. In times like these, pros turn to algo trading. Algorithm trading involves using special software to quickly buy and sell stocks. This helps them take advantage of small price movements in a matter of milliseconds. Let's dive into failed trades. Sometimes your trade won't fill. For example, imagine you retrying to buy a stock, but there's no sellers or enough sellers in the market. In this case, your trade won't go through. What happens next? First, your broker will retry the order a few times. If it still doesn't fill, you'll receive an error message. It typically looks like this: your order did not fully fill due to insufficient liquidity. Don't worry, this happens to the best of us. Pros handle this by adjusting their order type, moving the trade to a different market, or even canceling it altogether. If you've ever traded before, you've probably seen this message before. It's totally normal and happens when the market isn't playing ball. And that's what happens when you click buy. You've just completed a trade in a matter of seconds. It's pretty amazing how much action happens behind the scenes. Want a deeper dive into algo trading? Check out this video here or subscribe for more trading breakdowns. Until next time, happy trading!